Hello guys, today I want to introduce you to one of the easiest trading strategy that can help you to become consistently profitable. It is one of the trading strategy that have really helped me in staying consistently profitable, and today I'm going to tell you all that you need to know about it. But before then, there are a few things that I want to get out of my chest, and one is, do you need a big account before you can trade this strategy? The answer is simply no. If you have about $100, you are good to go. The second thing is, how much of experience do you need before you can trade this strategy? Like I said, it is one of the simplest trading strategy, so you don't need much experience. So if this is your first video you are watching about Forex, all you need to do is learn how to identify this strategy properly on a chart. So let's go into a chart and let me show you how to identify this strategy and how to trade it. First of all, we are considering bullish market. After a strong bullish move to this point, it finds a resistance and price is immediately rejected. It bounces down, finds support, and it gets rejected again. It rallies up to form a higher high, push down again. So there is always a strong rejection each time price hits the upper trend line or the lower trend line. Price will be strongly rejected at this point, at this point, at this point, and at this point. Same will happen at this point, this point, this point, until we have a strong bearish breakout. The breakout has to be a strong volume breakout. If not, you don't enter. And another thing you have to know again is that we are not talking about consolidation. It shouldn't be this way. It shouldn't be price consolidating this way. We don't call this a rejection. We don't consider consolidation as part of the strategy. It has to be a convincing rejection. So here we are. I took this trade some weeks ago, and it's one of the examples I want to show you. So this is a US dollar Swiss franc on the 1 hour time frame. After this strong bullish move, you can see price got to this point, and you can see the strong rejection. It came here, found support, and it bounces back to form another higher high here. Same situation, it was rejected, got to this point, and price got to this point again, form another higher high before it was rejected, and we have this breakout. You can see the strong volume breakout. So the breakout we consider, it has to be a strong volume breakout, and afterwards you see it was a wash through. Let me show you another example. You can see after this strong bullish move, price got to this point, finds a resistance, and after that got pushed back, and the same situation just as the first example, and we have this strong bearish breakout. After that, price rallies up a bit and there was a wash through. So it has to be a strong rejection, just as you can see at the upper trend line. See this strong rejection, this here, this here. So how many touches do we have? We have 1, 2, 3 touches, and we have 1, 2. Now let's look at a bearish situation. So in a bearish market, it's the same just as the bullish one, but we are looking at it in an inverse way. So you have your strong bearish move. After that, price gets to this point, price finds support, rallies up and form a resistance. After that, it gets rejected, forms a lower low, then goes up and form a lower high. So price gets squeezed this form until we have a bullish breakout. At this point, we should be looking for a strong bullish candle. That's when we consider the breakout to be valid. If the bullish breakout is not strong, then you have to let it be. So this is British pound against the US dollar, you can see the strong bearish move. Price found support here. It comes here to form resistance. After that, you can see the strong rejection before it bounces up here, and we have this breakout. And you can see the candle here. It is a strong volume candle. If you understand how to read your candlestick properly, these are 3 white soldiers, 1, 2, 3. So it's a good bullish sign. So we have strong rejection here, we have another strong rejection here, same strong rejection here, and we have another strong rejection here. And I told you it has to be at least 2 rejections. So we have 1 rejection here, have another one here, it makes it 2, 1 here and 1 here. So we have 2 touches on the lower trend line, and we have 2 touches on the upper trend line before we have this breakout candle. And after that, it was a strong rally. Whoever takes this trade would have made a whole lot of profit. Now that you know how to identify this pattern, how can we trade them? Now, for our entry, after the strong bearish candle, we can either sell at this point, or we wait for a pullback just as we have here and sell within this zone, which is much more safer. And if you enter at this point, your stop loss here, it means you have a very good risk to reward ratio. If you enter at this point and your stop loss here, your risk to reward ratio will still be good comparing how much profit you'll be making right here. Second example, you can see after this strong bearish candle, you can either enter here or you wait for a pullback. If you enter here, then you are trading aggressively. But if you wait for a pullback, then you are trading in a conservative way. However way you choose to trade is okay, but your stop loss shouldn't be so tight that you get taken out of the market before the move materialize. So let's go to the bearish situation. You can see the breaker here, and you can see 1, 2, 3. These are 3 white soldiers. Is another bullish sign. When you see these 1, 2, 3 candles, it tells you that you are having a strong bullish run, which is another confirmation for you to enter here. So this is your breakout. Like in this case now, after this breakout, if you enter aggressively, it would have been much more better. If you have waited for a pullback to this zone, you will never have had this second opportunity to enter this trade. So one advantage of entering aggressively is that you don't miss out on trade. But another advantage of trading conservatively is that yes, you may miss a lot of trades, but your trades will be more reliable. Your losses will be minimal because you don't trade based on impulse. Now that you know how to enter a trade, trading this strategy, how do you exit this trade? Now, one of the easiest things for you to do is to consider each swing low as your take profit point. But what I do is by using Fibonacci retracement tool to identify my TP point. So if you are using Fibonacci retracement tool, you measure from the swing low to the swing high, then you mark 50% retracement point as your final TP. You can take profit at 38.2 Fibonacci retracement level, but it's good your final take profit should be at 50%. The reason being that if you don't take profit at that point, the market might reverse against you. Let's go back to the second example. I'm measuring from this swing low here all the way to this swing high. So if I'm taking my profit, it will still be at 50% Fibonacci retracement level. So my first TP will be at 38.2 Fibonacci retracement level. Final TP will be at 50% Fibonacci retracement level. Let's go back to the bearish example and and let's look at it. Like I said, how do we take profit in a bearish situation? You measure from the swing high using Fibonacci retracement to the swing low, and your first TP should be at 38.2 Fibonacci level. The second TP should be at 50% Fibonacci level. At this point, it's good for you to get out of the trade, but if you know how to trade very well, you are good with how to read candlestick, then you can see how strong this candle is. Let's go back to the other one at 50%. You can see how strong the candle is before there was a reversal. So at this 50% now, this is a bit different, because after this point there was a kind of a rejection, but price quickly pulled back and we have a strong rally. Now when price got to this place, there was a pullback again, and after that we have a second strong rally. This is an AP equal to CD pattern I just played. If you have exited at 50% Fibonacci retracement level, you would have missed out of this point. But when you are trading, it's good not to get greedy. Sometimes it may go all the way to this point, other times it will just reverse, because this is a unique situation. So when you are trading this, you can use market structure to determine how price is going to go, but based on my experience trading this strategy, it's safe to take profit at 50%, but sometimes you can let it run. You can take partial profit and let it run, but it's good to be careful so that you don't have your win wiped out. As you have seen from the example that I've shown you, trading this strategy is really simple, and it's one of the simplest strategies you can ever find in the Forex market. It works in stock, crypto, and any other market you can think of. So for you to know how to trade this much more better with ease, it's good you have a good understanding on how to read candlestick patterns. So if you don't know how to read candlestick patterns, check out this video right here. Don't forget to like this video and subscribe if you found this video helpful. Thanks for watching, and I'll see you in the next video. Bye.